A lot of investors that I talk to are under the impression that the only way they can invest into multifamily and syndications is if they have the liquid cash ready to go. And even though cash is certainly a very common way of investing for people, it is not the only source of funds that you can use to get exposure to these large commercial multifamily syndications. So what I thought I would do in this video is talk about some of the other frequently used sources that sophisticated investors use in order to be able to invest into multifamily syndications and again, get that amazing exposure and diversification of multifamily in their investment portfolio. So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. I'm a multifamily investor based out of Boston, investing all over the country. And number two, guys, if you've been thinking about investing passively in multifamily, if you're looking for that large multifamily exposure in your portfolio for that passive income stream, equity upside, and the tax benefits, make sure you click the link below in the description, set up a call with me and my team, and we can talk about opportunities and see if, investing in our syndications is something that would be a good match for you and your investment portfolio. Let's get right into the meat and potatoes of the video. And as I said, what I would talk about in this video is some of the common structures and other sources of funds that I've seen investors use in order to invest into multifamily syndications, right? Because, even though cash is certainly, quite common way to do it, right? Where a lot of people have liquid cash, they write that check and use those funds to invest into deals. It is not the only way to do that. So here are a few other ways I would consider. Let's start with number one, which is using a home equity line of credit or a HELOC. Now, the way this works is, if you're someone that owns an investment, maybe a small investment property, or you've got a primary home that you've built up some equity in, what you can do is open a HELOC, right? And again, a HELOC is basically a line of credit that's secured by the equity in your house. You can go to a local bank, open that line of credit, and you can have liquid funds ready to go based on that line of credit. Now, since you're gonna have an interest rate associated on your line of credit, right? Because it is, HELOCs have an interest rate associated with them. What you're gonna wanna do is make sure that the rate that you're getting on your preferred return or the cash flow distributions is gonna be higher than the rate of your interest on your HELOC, right? So, for example, let's say your HELOC costs you 4.5%, 5% per month. Obviously, you're going to want to make sure you're getting at least 6, 7, 8% cash on cash on a monthly, quarterly basis, whatever it is, right? To be able to pay off that interest, so you're not losing money on a month-to-month basis. Now, what will happen is, that cash flow or preferred return, if that syndication has it, will cover, your monthly liability on the HELOC side. And then, the upside you're gonna get, of course, is the equity upside as an owner in that large multifamily deal. Plus, you're gonna have the tax benefits, right, which will significantly help your tax liability. So you're still gonna get quite a bit of benefits. So, in essence, you're essentially arbitraging the rates of the HELOC versus the cash flows from the syndication to offset that. And then you're taking the equity upside and tax benefits for yourself. So it's a great way to leverage existing equity that you already may have in your home or in other investment property that you own and use that to continue to grow out your wealth, income streams, and tax benefits. Now, the second most common way that I see a lot of investors investing in these multifamily syndications is through retirement accounts. And typically the most common types of retirement accounts that people use are self-directed IRAs or solo 401ks. Now, with this kind of strategy, what will happen is you can set up a self-directed IRA through a custodian, right? And if you don't know much about self-directeds, right, basically the advantage of those is that you can use your retirement funds to invest in alternative types of investments outside of the stock market, mutual funds, whatever, right? So you can invest in gold, metals, and of course, real estate using your self-directed IRA. So what you're gonna do is you go to a custodian, you open up an account, and then use those funds in that self-directed IRA to invest in those deals. What will happen is technically your self-directed IRA is going to be the entity that invests into the syndication, right? So it's going to be your self-directed IRA rather than you as an individual that's going to be invested into the syndication. So what will happen is every time there's cash flow distributions, right, those cash flows are going to go into your self-directed IRA. Let's say there's a sale in a couple of years and you make a boatload of money. Those proceeds will also go into your self-directed IRA, right? So, the cash flows will flow instead of from the property to you, they're going to go from the property to the self-directed IRA. So that's just one important thing you have to understand. But overall, it's a great tool to leverage, right? Because again, you probably have some idle funds in your retirement accounts that are maybe not generating as good of a return, right? Maybe they're generating 6, 7, 8% in the stock market and S&P 500, right? Whereas you could take those funds, invest to a multifamily syndication, get, 6, 7% cash on cash, but, average annual returns are typically well into the high teens, sometimes over 20%, right? So you can get quite a bit much higher returns in these sort of alternative investments by leveraging the power of self-directed IRAs and taking them to invest into structures like multifamily syndication. So hopefully that's helpful, guys. Hopefully that gives you some ideas about how you can use other sources of equity or funds in order to continue to expand your investment portfolio. Of course, if you have any sort of questions, make sure you put them in the comments below, and I will definitely help you out.